As we mentioned, the president's push to seize Greenland is now hitting stocks and your 401ks. On Tuesday, the Dow, NASDAQ, and the S&P 500 dropped by around 2% over the threat of a trade war with Europe. CBS News business analyst Jill Schlesinger is here with more. Jill, good to see you.
Good morning.
All right, so this was the worst trading day for all three averages since October. What happened?
Well, I think investors are really taken aback once again by the uncertainty unleashed over the weekend. This is really slightly different than what we saw during Liberation Day because there is a sense that the global world order that relies on rules is being broken. And we heard Mark Carney, who is the Prime Minister of Canada, come out at Davos saying, hey, we middle powers have to come together. I thought the quote that he said was pretty interesting. Middle powers must act together because if we are not at the table, we are on the menu. And I think investors are really freaked out by this, that there could be some fracturing in the world order. This causes them to sell stocks. They sold bonds, which pushes interest rates up. They sold the U.S. dollar, and they fled to safety in gold, which reached a new record high yesterday.
And if the president follows through with the 10%, the threat of the 10% tariffs, and normally he follows through on his threats, what do you think would be the impact on the economy and for the consumer?
Well, I think for the economy, it's Europe that will suffer more. I think in the U.S., from the consumer perspective, we might take a little bit of a hit to growth, but it's about inflation. We might continue to see inflation remain at this 3%, maybe 3.2% level. That's much higher than the Fed wants. I think the other part for consumers that's very important here, you heard me mention that bonds sold off and Treasury yields went up. What does that mean? That means mortgage rates could start to rise, exactly what the president has been arguing against. And this is about supply and demand in the marketplace, not any sort of mantra that is being directed at the Fed.
Oh, not mortgage rates. I mean, we're just hoping for them to come down. Jill, I mean, I got to move. But what should people do in terms of guidance? Should they look to last year and how the markets reacted?
I think last year is instructive about not being reactive. Last year, we came in with the stock market very strong. We fell tremendously in April, down a lot. We were at a low of 19% off recent highs. From the April lows to the end of the year, the S&P 500 was up more than 37%, finishing the year at over a 16.6% return. Do not react. Tune out the noise. Stay the course. I'm sorry.
Always say this.
But it worked last year.
But it's hard not to freak out when you hear this kind of.
Okay, so freak out, but don't do anything.
Okay. All right.
Jill Schlesinger, thank you so much.